All right, good morning, everybody. Want to welcome you to the webinar. Before we go ahead and jump into it, could we do a quick little sound check? Just go ahead and type a yes or a Y into the chat if you can hear me all right. Beautiful. All right, so last week, for those of you that were on that one, we went through and did a little PowerPoint. We're actually planning on doing the same thing on this week's webinar as well. So Wade is going to be going through a PowerPoint he put together for expansion lines, and we plan on having this as a new unit or just further explanation that's going to be in the virtual classroom. So we're going to go through it, do it live, and as you go through, feel free to type in questions or anything, or if you don't understand something, feel free to let us know because we want to make this as clear as possible. We are going to wait to answer the questions until after we're done with the presentation, just so he can kind of get through all of it. But otherwise, outside of that, kind of same thing as normal. We have a little bit of scripted stuff to start off with, and then we're going to jump into, maybe some of the markets that you're looking at. It's like, hey, I have this trade that I'm going on, or I'm thinking about getting into this. Do you have any thoughts on it? Just overall, this is probably going to be a little bit shorter webinar. We're looking to keep it to about an hour or less, kind of depending on the amount of questions that we get, because the market, as I'm sure you all know, is going to be a little bit slower this week because of the holidays and everything. So anyways, that being said, we will go ahead and jump into it. Oh, actually, one more thing. I know we have a few new people on here. Just wanted to make a note that if you have any tech support questions, this isn't really the place that we go over that sort of thing. Try to keep that to the technical support unit inside of the virtual classroom. All right, now with that being said, I'm going to go ahead and hand it over to Wade for him to go through his presentation and answer some of your questions. Thank you, everyone, and Wade, take it away.
All right, thank you, Shane. I want to welcome everyone to the webinar. We got some new people on. I want to welcome you guys to Trade ATS. We're super happy to have you on and can't wait to work with you. So for those that are on here that you don't know, we did open up the waiting list, so we do have some people coming in. Anyway, we're excited to expand our community, and it's exciting stuff. So that being said, I do have a PowerPoint presentation I put together for you guys. Last week, if you watched the recordings or you were on the webinar last week, we did do a PowerPoint that was all about boxes. What do they mean? How are they formed? Why are they important? This week, we're going to do expansion lines. What do they mean? How are they formed? Why are they important? The PowerPoint is not very long. It's actually only a handful of slides. But what I'm trying to do each week is that I'm trying to preview content that we're kind of progressively redoing the online course over time with. So I'm going to share that with you, these pieces of content. I'm trying to do it every week. And we're actually, I'm hoping to get some feedback from you guys on it and kind of see some questions you have after the presentation so I can tweak it and then ultimately put it in the online course. Because my goal with the content that we put out is to get it crystal clear so you guys understand the chart mapping tool that we have and you understand how to implement it effectively. And what, if you get a certain behavior or a certain signal, what that means and how to deal with it. So we do that through presenting things to you guys, getting a little bit of feedback and maybe doing some tweaking and then ultimately putting it out there. Anyway, so let's go ahead and get started. See here, and I apologize if I'm a little choppy. I put the final touches on this PowerPoint yesterday afternoon, so I've never actually even gone through it publicly. So like I said, I'm just gonna be kind of getting through it, but just bear with me and we'll hopefully you guys learn something from it. Okay, so everything you need to know about expansion lines. For you guys that are new with us, the expansion lines, if you haven't been through the full online course, the expansion lines are the white lines. When you load up the ATS 2.0 software, you'll see the white lines. They'll either be white lines that appear by themselves or white lines that appear in association with blue boxes. That is an expansion line, okay? What we're gonna cover is how they are formed. So you're gonna get a little insight into what makes the software print an expansion line. what do they represent? So what do they actually mean? How are they important that way? And why are they important for understanding markets? So what information can we derive from an expansion line or that level that is meaningful to making decisions with? Okay. So how are expansion lines formed? Okay. Expansion lines appear when our algorithms confirm price has left a contraction zone, signaling the expansion phase of the market. So if you have a situation where there's a box, the minute the price gets above or below the high or low of that box, you're going to get, essentially it's a breakout, pretty simple thing to get your head around. It's a breakout, and that's going to trigger an expansion line to start forming. Okay, and you'll get that with a white dot on the screen. I made them gray here just because we have a white background, but obviously they're white on the software. Okay, they're gonna appear immediately after price exceeds a higher low of the current box or the close of a box confirming candle that is already broken out. We covered some of this last week on the webinar, that sometimes there can be a one candle lag to a box forming, and that's because the breakout and the confirmation happened all on the same candle. We can't get around that slight 1 bar lag in order to get it to not repaint. It's just kind of one of the things. It's a rare occurrence, but it does happen. But if that does happen, you will get an expansion line trigger because it's triggered on the breakout of a box. And so if it shows that a box is formed, a breakout has happened, all on the same confirming candle close, then obviously an expansion line will appear with that as well. So how are expansion lines formed? Expansion lines can also appear by themselves without an attached box. So you guys look on your charts, you'll see the expansion lines, they don't have a box next to them, but it's still a white line, okay? What this is basically our algorithm has identified a relevant expansion point, even though the contraction formula was not met immediately before. So what it's looking, the expansion formula, I'm not going to go into how the algorithms actually, obviously the calculations of it, but sometimes there are situations where the algorithm will define that this is a sensitive market maker point, a balancing point for their book of business. And even though just the way the candles formed, it didn't, there wasn't the criteria to actually build a box. Excuse me. There wasn't criteria to actually build a box, but there was still a balancing point created in the market. So those expansion lines will appear without a box. Like I said, this happens due to the nature of how different time frame specific candles open and close. When you're dealing with price associated with time frames, that's one of the things. You have a constant flow of price data coming through into MetaTrader, and we classify that in different time frames to basically write an algorithm around. There's really no way around that. But the one drawback to dealing with specific time frames is that sometimes when you have to deal with on specific calculations, you have to use open close data on the bar itself, and it does limit you sometimes in that way. But the expansion formula between the box expansion and the no box expansion, just we call it a dot expansion, you're going to catch most every single sensitive point in the market that's relative to the time frame you're dealing with. So this is basically our way of getting those expansion levels that are still sensitive, but don't have, like I said, they just didn't work out to have the box. So anyway, hopefully that kind of clears that up a little bit. And these expansion lines mean the same thing as ones associated with the previous box. They shouldn't be given any more weight as far as expansion lines without the box, or those are more definitive than ones with a box. It's all the same thing. Okay, so treat them the same way. So what do expansion lines represent? So expansion lines are the dividing point between market taker, not market maker, market taker, buying and selling pressure relevant to the time frame being viewed. Okay, so what's a market taker, first of all? A market taker is someone that wants to speculate on the market, essentially. They want to get a buying or selling position. They go to a market maker, and the market maker makes them a market. And the market maker's job is to either match up their request, whether it's a buy or sell order they want to put in with someone else in the market, or they take it on themselves, which is a lot of the case, that they take it in-house and put it on their own book. So the expansion lines are going to be the dividing point between market taker, buying and selling pressure relevant to the time frame being viewed. So as you get above an expansion line, you're going to get increased buying pressure from people wanting to, they see the breakout, they want to buy the market. When you get below an expansion line, you get increased selling pressure. Okay. Expansion lines also represent the balancing point for the market maker's book of business. Okay. So as you have people, you have this neutral zone, the balance point. As you break out long, you're going to get market taker buying pressure, which is going to go through the market maker and create. They're going to be doing the opposite of those market takers by making a market to them predominantly. And anyway, so that's how the pressures go up and down. So expansion lines serve as a leading indicator of volatility entering the market. So what this is basically when you see an expansion line pop up, that's what it's telling you is markets are about to move, get ready. So you have that leading indicator that you're going to get some sort of buying or selling activity away from that expansion line. It's going to travel. So if you think markets, if you're trading a market and you're like, wow, this market's really slow, then what you can look back, you can look at higher time frames and see, are we in a box or did we just recently break out of a box? I'll tell you right now, if you want to predict when a market's going to start trending and you're going to have some really good days, you can go look at the daily chart and you can use ATS Assistant to do this, but program it to give you a signal on a box expansion. And I'll tell you right now, when you break out the high or low, the preceding days, if you're trading the 15 and the 4 hour, when you get an expansion on the daily, that tells you that probably the next week to 2 weeks are probably going to be really good trending days overall. Maybe not every day, but that's telling you volatility is entering that market, and that's timing your aggressive approach to a market that's actually going to be tradable. Which is if you go back test it, go look at the daily chart, go look at every time you get an expansion on the daily and go see how the market swings around. So, and we don't know if it's going to go up or down. I mean, there's more analysis that needs to go into it, but what you do know is that you're not going to get typically days that have 30 pip ranges, which is good news. We want trending days. We want days that move, 100 pips per day, ideally. So if you want to trade as those are coming into the market, and you get that leading indicator that, hey, well, I'm going to be having some good days, it's time to go to work. And then because a lot of traders, what ends up happening is that they see a market move, they see it go 300 pips over the course of a week, and everybody gravitates towards that market. They say, okay, this is the market that's moving, this is the hot market, I'm going to jump on it, and they trade themselves right into a box, which is the most difficult market to make any money at. So what you're trying to get through that box expansion signal is you're trying to time your approach with the probability of having significant movement in those upcoming days. So anyway, just a little thought there. Okay, here's an example. So in this situation, we got a rising market, and depending on what's happening and the other technicals associated with what people mostly look at, let's just, for this example, we're going to say as the prices kind of come up, made a top here, you're going to have selling pressure and buying pressure. You're going to have people that think this is an entry to go short. You're going to have people that think this is a trend change to go long, or vice versa. So you got this selling pressure and buying pressure. And when this becomes equalized, it's naturally going to form a market maker balance point, meaning you got basically almost the same amount of willing buyers, willing sellers, and that makes that market settle into that contraction range. In our software, we'll typically draw a box at some point through that range once the algorithm's been triggered, okay? So that's going to create that balance point. So as a market maker takes this price down, okay, people see the breakout. The people that had that selling pressure at the top there, they started selling this market, they're going to get confirmed on their belief that the market's going down at this point, okay? So the balance point, in this balance point inside that box, the market maker had, let's just say for the example, there was an equal amount of buyers and sellers in that box. So the market maker is able to match those buyers and sellers up. Market makers collecting a bunch of spread. It's a relatively low risk point for the market maker to do business at that level. As the market falls and breaks out short, the market maker's book is going to become unbalanced. Okay, it's going to start to get heavy with buy positions from the market makers, their book. The retail traders are all going to want to sell, even institutional traders possibly. So because they're getting confirmed on that down movements, confirming their belief in a sell in a down market. So, but they're all going to the market maker saying, I want to sell, I want to sell. And market maker, as the dealer of the market, they're saying, okay, I'll take that trade. And they're going to buy, they're going to buy, they're going to buy. So the market maker's book is getting unbalanced with those buy positions. Okay. If they can't sustain that, if they didn't have enough sell positions accumulated before to distribute into this falling market, they are going to have to bring the price back up through their balance point to redo their book of business so they're not losing money. You realize if this market continues to fall and the market maker stacking up buy positions, they're going to be out of business. So they have to rebalance their book and get some orders that they can distribute, or eventually they'll hedge their positions, which we'll talk about in a second. Okay, so a lot of these situations, what creates that master pattern kind of typical situation is this rebalancing approach that the market makers have to do to stay in business and not lose a ton of money. Okay, so they'll drive it back up through the balancing point. Now, as they get above the balancing point, the traders are going to now see visually the market is now going up and they're going to want to buy. So now the market maker's book is going to start getting unbalanced with sell positions, which they may ultimately want, because the market maker probably, in this example, you'll see as it unfolds here, but the market maker has to come up with an opinion of where price is going as well, because their job is to facilitate trading, basically take all trades, don't turn away business, and to make money from proprietary trading. So in this situation, the market maker had to do this they had to basically manipulate the market long to get rid of their buy positions that they were accumulating, because they still think the market's going short as well. So they drive it up long through the balance point. They'll get a number of people wanting to buy the market. They will happily sell to those people. You'll see that represented in that activity going long, and then ultimately drive it back down through the balancing point. And in this point, when they get back through, they go into the trending phase. They have, not only do they have orders that they can distribute at profit into that falling market, but they also, if they didn't accumulate enough, they can also hedge their positions in other markets, and basically protect their overall book. So what typically when market makers are going to hedge their business, that's when they're going to allow the price to fall, because they no longer need to keep it in that dealing range to be safe, and that's where they'll let the overall buying or selling demand take over, and your markets will trend. So anyway, hopefully this kind of gives you guys some framework, but the main thing, the importance of those expansion lines is that they are that balance point between this type of activity. So obviously it's definitely a very important component when using our software, when using our approach to understand what's happening, the activity that's happening around these lines, and putting together that puzzle. Okay, so why are expansion lines important? They provide exact price levels that make up the underlying framework of real buying and selling dynamics. The expansion lines create basically the sensitive price levels that are really sensitive. It's not us imposing our beliefs or our moving averages or our arbitrary price levels based on past Fibonacci retracements. The market is defining itself what is the sensitive data, and we are going to interact with that sensitive data. Okay. They give ATS traders specific prices where current market sentiment will change. You guys know, as you tip above and below those lines, the thought process that's going inside the heads of other traders, because they're getting confirmed on their buying or selling beliefs. Okay, but you got to understand, with the market maker mediating that, The market maker has to either balance that book or they have to get themselves on the right side of the market before it's actually going to go into a trend. And everybody that gets into a buy or sell position hopes that the market is always going to just take off in their direction. But with those expansion lines, you may get information contrary to what you want to happen. That way you can react quickly. That's what this is all about, is being able to react and have relevant information that allows you to do that. So they provide ATS traders a solid basis for decision making and strategy execution. Again, going back to the stable framework, you have something that is non-repainting that gives you the same specific information. So over time, as you get familiar with that, you have a situation where you can create even a new strategy, or you can work with that framework, and you know the sensitive price levels. You know what they mean. The meaning never changes. As long as the markets operate the way they do, through everybody going through a market maker and not directly exchanging with each other, there will always have that mediation, and the mechanics of that, of how business is done with that mediation, you're always going to have that inside look into that. So, and the expansion lines are not controlled by specific indicator settings, yet they give the same predictable information every time. This is super, super, super important. What we try to do with the base ATS chart map indicator, it has no settings. There's no settings to change, which is absolutely fundamental. When I wrote the algorithm for ATS, I already went down every rabbit hole you can go down, trading robots, systems, you name it, everything. And the problem with all these systems is that they have settings, everything else out there. And the markets, the ranges, everything changes. So you'll see any EA or any robot that's advertised out there that shows good performance and all this stuff. It's all tailored for a specific market condition. And when those market conditions change, it no doubt will fail, or it'll have an extremely big drawdown that most people can't live through. The biggest thing with ATS is, even though it doesn't necessarily make trading easy, it gives you a non-repainting truth of the market. That gives you, and it's not dependent on settings. It's purely dependent on price action, predictable price action patterns that happen over and over and over and over again. So that's what we're striving to give you guys, is that foundation that never changes. Even if you don't want to take our approach with our basic strategy, you can tailor this to something else that you want to do, some other constant behavior that you see in association with the lines, because you have a consistent framework to do that. If you go use a moving average, you go use these other things, what setting worked today may not work tomorrow, or the setting that worked this month may not work next month. The algorithm that draws the boxes, draws expansion lines, draws liquidity lines, never ever changes, and we can't change the setting to conform to a certain market type, which is, in my opinion, just my opinion, is the most important thing when devising any kind of systematic approach to the market, is to have information that gives you a constant that never changes. So this makes expansion lines a key factor in providing evidence against random walk theory, which makes them a building block that shouldn't be overlooked when constructing a successful market approach. For those of you guys that are newer to trading, if you don't understand what random walk theory is basically, it's not as popular anymore, but it's basically there's people that have a view that markets are 100% random and they cannot be won. Obviously, there's fund managers, there's a bunch of people that consistently win in the markets. So this has been disproven over time. But the way that this happens is because they found a behavior in the market that wasn't random, and they expanded on that and created a systematic approach around that. So the expansion lines prove, because they consistently get respected and they give the same information, that first of all, random walk theory obviously isn't the case, which we need that to not be the case to have consistent success, not only in the short term, but over the course of years and over the course of your lifetime in trading. You need something that's solid, that never changes, that you can really build a skill set around. But definitely, this shouldn't be overlooked when constructing any kind of successful market approach, whether you're using our software or not. the boxes and expansion levels should never be ignored, even if you're drawing them manually or you're using our automated approach, because they are a constant in the market. And if you overlook them, you're going to overlook very sensitive price data that would keep you from taking possible bad trades or staying in too long in trades that you have a good profit and giving it back in situations like that. So anyway, you definitely do not want to overlook the data that is given by these levels. So that being said, that's what I got for you guys on the PowerPoint. Let me pull up the charts here and I'm going to get into some of your questions. Hang on. Okay.
Hey,
So,
Wade, if I could just interject real quick, there's a really great example of price moving around an average price line, expansion line on gold versus the dollar on the 4 hour and 1 hour chart in particular.
okay, I'll take a look at that in a minute. Give me a minute. I'm gonna catch up on your guys' questions here, just because I want to see, want to answer anything relevant to the presentation here. Hang on. Okay, question from William. Question is, do you place live trades on the webinar? No, because we're predominantly, especially, I don't do a whole lot of short-term trading. I usually hold longer-term positions over the course of weeks and months, especially from our time zone. So no, the purpose of these webinars is to educate on the software. We're traders obviously, but we are a software company, and the purpose is to get you guys to understand how to use the software and basically the definitions behind the events that occur with the software. So that's, these webinars are get you guys up to speed. We are working on some new content that we will be going over live trades, longer term positions mostly. We will do some short term trading in there as well, but that's part of the content that's being developed right now. So we will have some of that stuff, but not on a live webinar. There's no like I said, it's not going to work with our time zone and the style of trading that we do. We don't do a whole lot of short term trading. Not to say you can't. I have a lot of guys trade 5-minute charts. A couple guys trade 1-minute charts, but they're usually in Europe. They're able to trade through the entire sessions. We're in California time, so we're kind of at somewhat of a disadvantage for short-term trading just because of our time zone. You'd have to be up at midnight essentially and trade all through midnight to be able to maximize the shorter-term opportunities. So, but anyway, we do have some content that we'll walk through some live trade scenarios coming out. We did have some ones that were from a long time ago, but I got rid of them because I want to redo them just because I think we could do them a little bit better. They were like trades from like 2-3 years ago, something like that. So anyway, we'll have some of that content coming out. Let me keep reading some of your questions. Hang on. Oh, Richard, it's cool to see. I see your comment here. It's not really a question, doesn't sound like, but I've been trading for 15 years. 3 of the years been studying basically the accumulation phases and basically our style of methodology. We're happy to have you on. Richard makes a point. He was drawing these boxes and doing the mapping himself before He got our software, and I'll tell you that's how this stuff was born. I drew these lines for years before I ever turned into an algorithm. So that's how it starts. And I always tell people, you don't need our software to to map the market successfully. All you have to do is you have to accurately identify the contraction points. Even though we do have some more advanced things, because we do have the expansion lines that come without boxes, and that is a proprietary algorithm. So you'll probably get more information from our software. Well, you will get a lot more information. But you don't, if you guys can identify boxes alone, that will give you enough framework to make good trading decisions based upon. So obviously we appreciate you guys using the tool, but like I said, it's ultimately, you don't need it to find these sensitive points. One thing I will tell you though, as you use our software and if you're new to this approach, the one biggest benefit besides being a stable platform is that it's going to train your brain to think opposite of everyone else, which is invaluable. To get you to think of the market in context of three market phases: contraction, expansion, trend, and to classify it in those three, it's going to simplify your life. And the more familiar you get it, like I always tell my brother Shane, once you draw boxes, you don't go back. You will never look at, once you start looking in this methodology and you see the sensitivity of these levels, you may get frustrated with your trading every once in a while. You may make a dumb decision, or you're still learning, and you say, forget it, I'm going to go use a moving average, I'm going to go use some sort of EA, whatever. And you'll always remember in the back of your mind, man, those boxes and those lines, I think that was good information. I think I should give that another try. You always come back. So, you guys are on the right track, even if you're still on your journey overall. So let me keep reading some of these comments here. Hang on. Okay, see your comment, Toy. Thanks for the question. So, the question is, so the white expansion lines basically if it's, do you buy or sell below? I think is what you're trying to say on the expansion line. If you look at the basic methodology, that is, we're going to give you something very, very basic to start with. In reality, what you have here is you have a framework. Ultimately, that's what you have. You have a framework of sensitive price data that will allow you to understand when a trade is good or it's not so good, so you can make quick decisions. That's really ultimately what this is, and that's the value in it, is that you have that non-repainting framework. The strategy that we push you towards in the beginning, because everybody needs a starting point. If I tell people, I'm like, look, you guys have a framework. So the people that have been trading a long time, that they get it. They see this screen and they're just like, oh my God, you got to be kidding me. It doesn't repaint, and they see the sensitivity of the levels. They're like, I can do so much with this, regardless of what we say. It's that consistent framework that gives them that's what empowers them. But I know a lot of traders that are new, that's like they need rules, they need a systematic approach, because, and especially because they've been indoctrinated that that's the only way that that you're going to be okay in the markets, is if you have this 100% rules-based system. So the bread and butter in the system that we give you is finding the trend and finding counter trend liquidity coming into the market and trading back towards the expansion line. I'm going to tell you, it's a really good strategy. But overall, as you grow with this approach, you're going to go from seeing a narrow strategy like that. I'm going to look for a rotation on the higher time frame. I'm going to look for a pullback, a counter trend pullback based on the timing of an expansion line. I'm going to trade back towards that expansion line. You're going to move from that narrow focus that you start with to seeing the whole market. You're going to be, instead of looking at one candle, you're going to look at a whole range. You're going to look at the boxes together. You're going to look at overall framework. And that's really ultimately where you're going to be able to make certain calls that are kind of defy logic in some situations. Other people would be, there's like nothing on my screen telling me to do that. And you're like, well, the way I see things forming in regards to the levels I'm working with, that the decision makes sense to me. So that's eventually where you'll get to if you spend the time to keep trading with it. But going back to the question, if you get above or below, what we're looking for, the basic strategy is that, going back to what expansion lines mean, is that above or below, you're going to have retail, let's just call it retail money coming into the market and driving that market. So what we're looking for essentially, let's see, we got the dollar CAD. So let's take a look at this run right here. You got above expansion on this candle. So you had these 4-hour candles that were trending above the white line here. Okay. So let's jump over and look at that run. Okay, wow, this one really took off. This is probably going to head back down, which it is. Okay, so right here you got into the criteria up here, and as you're getting these runs up here, when you're looking for a counter trend pullback, so you're looking for an expansion line, you got an expansion level here, expansion level here. This is really your first opportunity based on the basic strategy to get into the market. So as you see, it pulls back against the 4-hour, it rotates back long and gravitates towards those expansion lines. And the facts are, what from a mechanical standpoint of what's happening behind the scenes, going from the market maker's business, how they do business, is that on a higher time frame, if we know that there's, let's just say, a retail buying demand that's coming into the market, and it's on this higher time frame, we know that retail traders are willing, every time they get price moves up, they're going to want to keep buying the market as it breaks out. On the shorter time frame, when we get counter trend liquidity against that, we know basically that what we're assuming, as long as this stays intact and these candles stay green, is that any movement against that below, you have to have the expansion line because that's what gives you the correct timing. But we're expecting that on the lower time frame, this is just going to be a balancing or accumulation tactic of the market maker to go back in trend. So we're using the expansion line to time our approach. We're going to let that pull back. We're going to look at previous levels to see where they're going to pull back to, and we're going to enter back coming towards that expansion line. That is ultimately what we're betting on in the basic strategy, is that the market maker is going to continue to drive and push the retail, or let the retail traders come in long, but on the short term, they're going to use that situation to basically make money in trend on the shorter time frame scale, and we're trying to align ourselves with them as they balance their book. So, and if you guys have questions on the basic strategy, that's one of the things that those videos that we did, that we made, those, I think I made them over 2 years ago, something like that. So those are part of the things that are going to get remade since our program's grown. We're gonna be redoing a lot of the content. When we first got started, I had the privilege of doing a lot of coaching calls because we were offering a 30-minute coaching call when people signed up, but it got so crazy with people wanting to sign up, there was no way we can sustain that. So that's why we started doing the webinars to replace it. But I did get a lot of feedback up front from hundreds of people in what they're dealing with and the things that are making that would make it easier to understand. So since getting that feedback, we are recreating a lot of the stuff in there. Not that what's in the course isn't good enough, but there's things I think could be made a little bit clearer based on the feedback that we've gotten since our program started to grow so rapidly. So but anyway, I would go over those basic strategy videos, and every time you go through them, you'll pick up another little nugget of information. But ultimately, like I said, the goal is to get you to move from the basic strategy. You'll always be able to see that strategy happening, and that will be part of your approach. But overall, is to get good at looking at the overall framework of the market. Okay. I actually have my liquidity lines turned off on this chart. So you guys can see, I've showed you guys this before, but you guys don't see this on your version. But this is the back end of the software. And there's no settings. Like you said, if you see that again, I can't change the periods. We have max history bars, which you guys have as well, which just gives you more bars backwards to draw architecture from, but there's no settings. So I can never make this conform to the market or suit a specific purpose for telling you guys something. It is what it is. So you guys can be confident when you do your back testing and you go look at past data that what you see back there is what happened and it wasn't adjusted to make it look like something that didn't happen in real time. So like I said, that's one of the most valuable things you're going to get from this is that consistent framework. So let me catch up on some more questions here. Hang on. Hey, Richard, I see you're looking at the US 30. So I'll pull that up real quick just to give you some comments on that. Hang on. So I don't know what time frames you're trading on, but let me pull it up on the. I like to take a look at the weekly. I'm a big believer in the weekly and monthly time frames for fundamental direction. Yeah, I mean, well, let's just put it this way. I wouldn't buy right now. Not to say that the trend is over, but I mean, obviously the Dow's had a pretty epic run. But yeah, I would say like right now, if you're looking to enter this market, a good place to do that would be you want to wait till you're under expansion. So if you get a box here and you pull back to one of these levels here, these previous expansion levels, that's where I would monitor your risk based upon. But right now, this is not. It may spike, it may keep going long, but right now is not a great time to buy. If someone, let's just say they said you gotta make a trade and it's got to be positive at some point, I would definitely go short if I had to, but I don't see a trade right at this moment at all, at least on these higher time frames. There may be a shorter play on the 15. So let's take a look at the 15. So we had a play right here. Oh, this was probably the 4-hour turning, so this one probably wouldn't have been very easy to navigate. But as it turned back long, looks like we had one right here. Had a counter trend liquidity move right here against the 4-hour, and you'd maybe riding that, but obviously it's didn't really perform very well. So if you did buy this dip right here, you see it held expansion right here, which was a good sign. Rotated off that, and then you're above expansion at this point. You're in the profit zone up here in this level. Right here, it kind of had a chance to break out. I'd be covering as you come back down through here, probably at a break even. That's probably the chance I would have given it. But yeah, overall, I feel like there's more of a chance of a bigger short play here. You snap the high. Yeah, it looks like you barely snapped the high over here. So, like I said, I would wait. I would wait till you get more information. Depending on the time frame you're trading, I'd wait to get more information on it. Okay, so let me catch up on some more questions here. Okay, here's another question. What about if expansion lines are close to each other? What do we decide? What does that tell us? If you have a lot of expansion lines that are close to each other, what it tells you is that you got to look at your higher time frames and see what the story is. You always a good thing to reinforce your overall analysis is always find a higher time frame that's trending. Find a higher time frame that's in a give you the story of the lower time frame. So if your higher time frame in a situation like on your 4 hour, if you're in a box like this, what you can do is if you're trading a 4 hour and a 15, you go into a box, well, you can jump over and look at the weekly and see if that gives you any clarity as to what will happen at the end of that, when you exit that box and get a new expansion. But if you get a lot of expansions close to each other, what it's telling you is you're probably in a tight range, and that you probably need to give it some time because it's maybe even going into a box on the higher time frame. So it's giving you that. That's kind of the range of the market is what it's telling you, is that it's just tight. So, and we need the markets to trend ultimately to make any money at it. So if you're in a situation you think that things are tightening up on you, the best thing to do is do nothing. If you can't find something that's totally clear, don't do anything until you find something that's clear. Okay. One comment I want to make too is that we got an email, or I got an email yesterday, I think it was. Someone was saying they're having a hard time trading and it doesn't seem like anything's working out. I can't, when you're using the basic strategy, I can't emphasize enough that you need a trending market. And I know I say this almost on every webinar, but you guys have to be confident in your higher time frame that it's trending or it has the potential to trend. If you don't have that confidence in the higher time frame, and you will build it over time, watching it play out, then don't touch the smaller time frame until you feel that higher time frame is going to continue. Don't even look for an entry on the smaller time frame. And also too, if you guys are newer to trading, do not trade lower time frames, especially in the Asian markets, unless it is an Asian, like it's like the Aussie yen or something like that. Even those pairs typically have pretty low volume. So, but if you guys are sitting here trying to tear up the market in those low volume times, especially if you're trading dollar CAD or euro dollar, those currencies are going to be flat during that time. And a lot of the trades, even the grade A and B signals, are not going to take off. There is no filter on those time periods. The next version will have a time filter that we're going to put out. But you guys will know, I know that more experienced traders, they know you don't trade in flat markets. If there's no volume, especially institutional volume to come in and push the market around, those small trades are never going to take off. They're gonna feel like they're taking off. You're going to jump in because you feel like you're missing out, and they're just going to come right back into the range, most of them. And every once in a while, you'll get a breakout and you'll get a significant move. But as a rule of thumb, you want to stay away from those times. You want to trade during the London and New York session, especially during the overlap when both markets are open. That's where you're going to get significant moves. If you concentrate your trading to those times and you identify a clear trend before you trade during those times, you're going to be at a much better advantage overall.
Wade, to that point, there was a question in the chat regarding trading during the holiday season. So what we're coming up into, like the rest of this week and, around Christmas time, end of the year. Do you have any thoughts on that?
Yeah, take it off. Yeah, typically when we get towards the end of the year, November, December, not to say there won't be some good moves, but especially the big holiday weeks, the markets they're gonna definitely. Well, let's put it this way: for as many years I've been trading, it's been over 10 years. It's been as a rule of thumb, the holidays definitely slow things down. Not to say, like I said, you could still trade. There may be some opportunities, but as a rule of thumb, I like to slow down. That'd be my recommendation. But obviously, anything could happen. It's financial markets, so there very well may be a big move. But that's what we're not doing much this week. Let's just put it that way ourselves. So let me catch up on some questions here. Hang on. Hey, Rich, I see I'm scrolling down through the comments. I'm seeing some of your other comments that you put, uh, uh, following up to your previous one. One thing I'm gonna, because I know you're new here, and it sounds like you got some experience too, so definitely appreciate that. Um, you got to remember that when you get above expansion, these expansion lines are like magnets. Okay, these are literally, if you're going from a mean reversion perspective, not to say that the market can't push, but you got to remember that eventually the trends are going to stop. So where you want to be aggressive is when you're around the expansion. If you're seeing, like right now, we see the weekly trend is long. So that means that when you get above expansion, you're going to pay more, particularly way more attention to these 4-hour rotations, or whatever time frames you're trading in that direction, because we know that the weeks overall are going to be predominantly long. So that should tell you what your expectation should be for the week. But as things pull up here, you have right here was the time to be more aggressive. Is down in here. When you get up here, not to say that you can't get another leg up, but everybody's seen this at this point. So I'm not saying don't trade it, but what I am saying is be careful. The whole thing, if you go, especially with the ATS assistant, the whole philosophy between the grade A and grade B trades, grade A trades, they are early, and some of them don't work out, especially if it's low volume or your higher time frames don't look good. But if your higher time frames look good, getting close to the turn is everything, especially when it comes to risk to reward management. So, like I said, I'm not saying don't trade up here, but, and this is for everybody on the webinar, you guys want to get close to the rotation. You want to find something that those very first entries are where you want to hang it out at. You don't want to hang it out at when you got something that's already clearly had, several legs, or it's already, everyone can see it. Okay, you want to get down in here, down in the rotation. That's where you're going to have the low risk and a potential high reward. Remember, the trends are not going to just keep paying and paying and paying and paying. If you're trading the 15 and the 4-hour here, yeah, you probably would have racked a lot of trades, a lot of winners, especially because of 4 hours above expansion in alignment with the weekly, going from the basic strategy standpoint. But eventually, you're going to pay a price to figure out that it's rotating like this. So if you look and you see a move, and before you start trading a cycle in a market, a leg on your higher time frame, go look and see how many trades on your 50, if you're trading a 15 and the 4, go see how many trades have already paid. So right here, you had some under expansion right here, and that had another big leg all the way up to liquidity line here. So that was pretty monster opportunity right there. Coming out of the box, these were in the box. This was difficult. You could have still traded. I do have some advanced guys that will trade coming out of a box. Especially if it's in line with the fundamental direction. But obviously you can see these entries were a little more difficult in the moment. So right here was really your best opportunity, and this thing, it had a lot of upside to it. And now you had another one right here as you're coming through the rotation of the 4-hour. But you do got to be careful, because like I said, eventually this thing is going to run out of gas. And one of the rules of thumb is that if you look and see how many trades have already paid in that overall higher time frame cycle, and you've missed, 3 opportunities that were clear, it's best not to get in when you've already missed so much opportunity. Now, if you've caught the first move, the second move, the third move, and you've taken a big chunk out of a move, you've earned the right to trade anything you want at that point, because you have money in the bank. But a lot of traders, they wait to see confirmation. They wait to see that the move is going, and then they get aggressive at the top. And that's where, going back to the illustration we had on the PowerPoint earlier, you're going to get more selling demand and buying demand, which is going to cause the market to go sideways into that market maker balancing point. And that's where you get situations like this, which everyone typically gets beat up in. So whenever everybody on here, whenever you're looking to take a trade, ask yourself how many trades have already gone by. And if you feel like the move is still young, then by all means, trade it. Even trade it when it's gone if you want to trade it, but don't trade it as heavy. Get aggressive when the moves are when they're close to expansion, and scale out as they get farther away, because eventually it's going to turn. Okay, this whole thing is as much about timing as it is about correct analysis. So the quicker you see a rotation and the quicker you're able to get in on those first opportunities, the better off you're going to be. And a lot of people, they sacrifice good trade placement for confirmation. It's kind of, you can't have both. It's the same thing with buying above or below expansion level. Sometimes you just got to pull the trigger because it's good. It's a good price. But if you wait for the rotation, you'll get confirmation it's going in your direction, but you're gonna sacrifice excellent trade placement. So you got to find a balance between confirming your beliefs and getting an amazing price. So something to think about. Okay, let me catch up on some more questions. Hang. Okay, great question from Bruce. Question is, he's a new trader on with us. Question is, what market is how do you tell when a market is moving from expansion to trend with a high percentage of accuracy? Um, and this is one of the biggest questions. And ultimately, all we have is probabilities. So what you have to do, and that's basically the magic of multiple time frames, is that you have to assume that a trend is going to continue, and you have to reinforce it with a higher time frame. So your accuracy is going to come from finding a higher time frame to support the behavior you expect on your lower time frame. For instance, looking at, again, the Dow, since we have it pulled up, you have a clear weekly direction. So when you get a breakout above expansion, you're already biased from a weekly perspective. That's your time expectation. This would have been this whole week, you're expecting the predominant moves to be long because you have that green candle above expansion. So if you know your week is predominantly long, you're going to be extra sensitive to breakouts that happen on the long side, or when price settles, for instance, like this. You see we get above expansion, and this is that typical back and forth, but then it settles above this level right here, and then it starts to move, settles again. So you'd pay much attention to these. And so if you're even going to a 15-minute time frame, if you're trading the 15 of the 4, the fact that you know that the week is going to be predominantly long, your directional bias for the week is long because of the candle tells you that. So that's very simple analysis. When your 4-hour aligns with that weekly directional bias, then you're going to have more trust in the 4-hour. Then when you get opportunities like a situation like this where it's ranged out, you're going to feel much more confident putting trades in below these prices because you know that the higher time frames are in alignment. So the higher time frames are what's going to contribute to the probability above and beyond 50%, gamble. The trend is what's going to put the probability in your favor, and you just need to trade. You need to understand the activity that's happening around these lines on the lower time frame to plan your entry. So that's how you're gonna up your accuracy, is by understanding the higher time frames. If you don't have a higher time, whatever trading decision you're making, if your higher time frame, if there's a question in your head that you don't understand, or you don't feel, let's say you feel kind of good about it, we'll trade it at a lower amount of money. If you feel really good about it based on experience, trade it with more money. You're gonna have to find that. But at the end of the day, if you don't feel good about the higher time frame, there's no trade on the lower time frame, whatever combination of time frames you're using. That's what's going to increase the degree of winning trades. You look at this weekly chart as we broke out of the box, even in starting inside the box, you had 1, 2, 3, 4, 5, 6, 7 weeks that all you had to do was be an excellent buyer of the market. That's it. That was your only job. Okay. That is relevant information for someone who's trying to be up in their account on a weekly, monthly basis, yearly basis. It is in your advantage to understand what the weekly direction is. And then when you get situations where the 4-hour and the daily align with that weekly fundamental direction, what does that say about opportunities like this? Should we be taking those? Yeah, absolutely, because it's in alignment with the overall fundamentals driving the market. Your fundamental analysis is all going to be reflected in those higher time frames. The big institutions that are taking out big positions in a market, that's going to be reflected in those higher time frames. They're not trading a 1-minute chart getting in and out. Well, maybe if they're high frequency traders and that, but overall your big investment firms and things like that, they're not looking to take 10 pips out of a market. They're trading off the weekly and monthly timeframes, and that's why those timeframes are typically way more stable. So if you ground yourself in the higher time frame, like the weekly and monthly chart, that's going to give you a significant advantage. And when you see situations, even trading the 4-hour and the weekly, where it's like this, counter trend liquidity below expansion holds above previous expansion, that's an opportunity on a 4-hour time scale. Now, I don't know if your situation allows you to be in a trade, because that's many hours you're sticking that trade placement, but that's what that means. The institutions are driving it long. This becomes an opportunity on that time scale. But unless you had the backing of the higher time frame, if you were just looking at this market by itself, like a lot of people do, they just have one chart that they're trying to set their trend lines up and everything. They would see this. They obviously wouldn't see our boxes, but they would just see the market turning and say, oh, this is probably a short. But until the higher time frames rotate, it's long. It will continue to be long until that weekly turns red. Everything's long from the weekly perspective. You may have some days against that weekly that go short, but the facts are the higher time frame always wins. This when it comes to analyzing trends. So you want to stick with those, and that's what's going to give you the higher percentage over time is figuring out, having faith in that higher time frame. And when you don't have faith in it, you don't trade. Simple as that. Okay, let me catch up on some more questions here. Hang on. A question from Bill regarding liquidity lines. If you on the 4-hour, if you have 4 or 5 bars beyond the line, is it still usable? What the liquidity lines are going to tell you, what they're giving you is they're giving you price levels where the market makers are either going to use that liquidity to push the market or they're going to accumulate it. So what you need to look at is you got to expect that 2 things are going to happen. You're going to get a pause or you're going to get a breakthrough. And what the liquidity lines are doing is they're giving you a decision point or a potential decision point that you need to adjust your strategy or your approach. So when you get 5 or 6 candles that are above and obviously just went through a liquidity line, what that tells you is that market makers are definitely interested in driving this market long. They're going to keep pushing it. So if you're, depending on what the situation is, if you're trading in trend and you come through liquidity lines in trend, then what you'd be looking at if you're in a position, you'd be hoping from your standpoint that they would use those liquidity lines to further the market. But if you see a significant pause at that level, it's usually a good time to cover. So something that you got to use those. It's every single piece of this software is going to give you a specific piece of information to put together a puzzle as things or as they form. So you got to, if you're 5 or 6 candles above, you got to ask yourself, what are the banks doing? Why did they disrespect that level? And see, similar to these lines blew right through. What's happened since then? Nothing but moving up. That was a clue into the continuation of this market. Now, if you would have got a heavy reaction off those levels, then we probably would have been headed down to here. So hopefully that kind of clears that up a little bit. Okay, let me keep reading. I see your comment, Toy. So yeah, you're definitely looking. The white lines are that balancing point. They're a balancing point, and you need to understand that what business is happening around that. Those white lines, if those are the market maker's neutral point, remember, as you get below a line, market makers are going to have to be predominantly taking sell orders from market takers, people that want to sell the market. So the market maker is going to have to get in buy positions overall, because they typically aren't going to be able to match them all up in a house. They're going to have to go on the interbank market, especially for bigger positions, and dump those positions or hedge or whatever they need to do. So the white lines, the key is to understand the dynamics of the business that's happening under, around, above, and below those lines, and use that information to form your own trading opinion based off of, and give yourself some framework to enter and exit the market. So yeah, you're definitely, you never want to use a line as this means if the line appears this way, it just means to buy. If it appears this way, it just means to sell. That's just pattern trading with no thought behind it. You got framework here, and it's telling a story. And until you figure out what the story is, don't do anything. And use the higher time frames, like the weekly. That's an advantage. It's a simple advantage. The fact of just understanding the direction of the week can keep you out of a lot of bad trades that are against that direction. Now, every once in a while, you may get a big reversal and you may call it perfectly, but as a rule of thumb, going back to, this is where you pull off your months and your years, is when you catch these kinds of cycles like this. So, you definitely want to not ignore that information, because it again gives you a constant that you can ground yourself in, and not get sidetracked with other types of analysis. The fact is, the direction of the week, pay more attention on, even if you're trading lower time frames, when they align with that weekly direction, get more aggressive. When they're not aligned, get less aggressive. Pretty simple concept. Okay, let me keep reading. So another comment. So comments only trade with the trend on the higher time frame. Yeah, you got it. Not to say that there's other things that you can't do, but as a starting point, if you have confidence in your higher time frame, whatever it is you're using, whether it's a 15 into a 4 hour, you better understand where that 4 hour is headed. If you're trading the 4 hour into the weekly, you better understand what the probabilities are of that weekly. And what's going to give you the probabilities is those expansion lines, the boxes. If you're in a box on the weekly, what kind of behavior do you expect on a daily basis? Probably pretty whippy, right? If you're out of a box, what does that tell you? You get a fresh breakout. It tells you that the coming probably couple of months, 2, 3, 4 months, you're going to have big swings on a weekly basis. So what's that going to tell you for your approach? It's going to help you get prepared for what's most likely going to happen. So have confidence in your higher time frame, so it simplifies your life, rather than trying to look at one chart or one set of price action and trying to figure out if it's going to go up or go down. When you have a clear defined direction on your higher time frame, that's the most beautiful thing you can get, because it tells you, is like, I just got to be an excellent buyer or excellent seller of the market, and I got to try to get the best price. And until that higher time frame goes against me, you maximize every opportunity. But like I said, if that higher time frame, you're unclear about it, and you will be to some degree if you're new to this, especially multi-time frame analysis, you gotta build some experience with it. But that really is, when you have that edge, a clear defined direction on your higher time frame. I don't care what system you're using. Obviously, you have way more architecture using the ATS approach, but if you're even trading just moving average crossovers, for goodness sakes, just trade the crossovers that are in the direction of the higher time frame, and leave everything else alone. That's an edge, to be able to understand probabilities in a single direction. So don't ignore that. Okay, let me keep going. Sorry, I'm going on a little tangent there. Hang on. Another good question. For someone working long hours, what's the easiest way to use this? Trade higher time frames. Trade the daily into the monthly, or the 4 hour into the weekly. I always like to look at the monthly, because it's good to know what the monthly direction is and what the probabilities are, because that'll give you an outlook for the weeks of that month. And the weekly will give you an outlook for the days of the week if you're trading every day. So Yeah, just it's the same thing on the daily into the monthly. Same exact thing we're trying to do. Same exact framework. It doesn't change. All you got to do is you need to adjust your lot sizes and the amount of risk, because when you're trading a daily chart for entry, you can't be surprised if you're down 100 pips because you just misjudged an entry. So you got to expect that's kind of part of the deal. You can't get freaked out by those swings, but also you need to leave yourself enough liquidity in your own account that you can layer on positions. If you don't judge it right, it goes 50 pips against you. You don't want to be so maxed out that you're like biting your nails. You want to have money to get a better price, because if your fundamental direction of your higher time frame, let's say it's a daily into the monthly, if the monthly is still intact and it still looks good to you, but you're down 100 pips, well, guess what? That's just 100 pips more opportunity that's in your favor still. So the biggest thing, one of the biggest things, if you guys read, there's a book, the Jack Schwager books, Market Wizards. I always recommend them. There's one, the New Market Wizards. If you read that, the theme in that book, America's top traders. This is obviously from the early 90s. This book was written, but they all leave themselves a ton of room in their account to be creative. And the problem with a lot of people coming into this industry is that they're seduced into it with the idea that they're going to make these like 100% a month or 100% a day, especially this ridiculous binary option stuff, 75% payout or 100% loss. And it's all time based. So, the binary option stuff is just, it's incredible what they're doing with that stuff. It's terrible, but there's a big draw with how people are lured into this industry with these hopes of making these unrealistic gains. And in reality, I know it's not as fun and exciting, but going off like the 1% rule, don't risk more than 1% of your account and try to have at least a 2 to 3, maybe up to even a 5% return on that risk. There's a reason people say that. And number one, it's by risking a smaller percentage of your account, it keeps you in the game. So those few opportunities when you get a new rotation on a weekly and you get a grade A signal on the 4 hour into the weekly, you can go heavy on those types of situations. And the fact that you've actually lived to see them and you didn't get blown up because you're trading 500 to 1 leverage on your tiny account, like that, there's something to be said for that. It's just merely being able to exist and be there when it's like, dang, this is the opportunity of the month, or this is the opportunity of the year. That's really what it's all about. No one ever is going to be able to knock it out of the park every day. Some days are just tight, they're difficult, but being there, being able to survive, and almost, for lack of a better analogy, people are playing poker or whatever, they're just playing the table minimum until that perfect hand comes along, and then they go heavy. Not that this is gambling, but that's you want to be able to survive. And the only way you could do that is by protecting your account capital until a situation presents itself where you're just like, I'm going to knock it out of the park. And if I don't knock it out of the park, it's a very low risk. That's why we created the grade A trade opportunities. I know some of them don't pan out, especially in the flat markets, but when you get a grade A opportunity, and you look at the higher time frame and you see that it's rotating in such a way that makes a lot of sense, it could turn into a big move, then that's something that you want to really be prepared for, because that's where you make your decent gains for, like I said, the week, the month, the year, depending on the time scale. So anyway, sorry I went on another tangent there. Let me catch up. I know we're running a little bit long here, but as you guys can tell, I love talking about trading. So let me read a few more questions here, and then we'll probably wrap it up here pretty soon. Kevin, question: how to get one-on-one coaching and training? We were offering that, like when we first started. I've been doing this a long time, but I did have a 30-minute complimentary coaching phone call for new people that signed up, but we started getting so many people that want to be in the program that I just couldn't make that many phone calls. So we're doing the webinar. We may bring back some sort of provision that would allow, if someone really, really, really wants a phone call and they want a more tailored advice to their particular situation, we will probably do something like that in the future. But right now, I mean, we're trying to just make good enough content to where people understand, what the system is, what it isn't, and how to engage with it, and get value from it. And we're trying to do that through videos and through webinars, just so it's a little more scalable. So that's our first priority, but we'll probably bring something back in the future, that'll, that will have a provision that way. So we'll obviously send out an email and let you guys know about that.
And I just wanted to follow up on that real quick. So also the coaching calls, it's great to be able to go over and have some one-on-one, but we've both been doing this for a while, and it's never one coaching call that makes all the difference. It's the continued effort of trying to understand what's going on with the software and all that stuff. If you guys want to send in screenshots, you take a trade and you want to send in a screenshot just asking what happened, just please make sure that you mark where you got in and out. Don't give timestamps because they're really, really annoying to find. But just mark in like maybe Microsoft Paint where you got in, where you got out. This is exactly what I was looking at. Do you have any thoughts on it? Try and keep it a little bit shorter because there's a lot of them that come in. But we'd be more than happy to throw you a little bit of feedback just on an individual trade. And that stuff compounding over time is going to make more of a difference typically than a one-off phone call. So, we encourage you guys just to send in your screenshots to the support@tradeats.com.
Cool. Thank you, Shane. There's a bunch of questions here. You guys are especially chatty this morning. There's a lot of good questions here, and I'm going to try to get a few more things in here. But overall, I mean, we're not going to be able to go. If you guys have questions, you can always send them to support@tradeats.com, and we're happy to work with you guys on that as well. If we can't get to your question in the webinar. So if I can't do that, and you have, especially if you have a question about a specific trade setup or something that you're looking at, probably not, if you're trading a 1-minute chart, we're not going to be able to get to it in enough relevant time to help you with a decision. But if you're looking at a longer term setup, we're more than happy to give you some feedback about that as well. So trying to see if there's any more that we can. Okay, I'm gonna take a look at pound Aussie real quick. I'm gonna do a couple more of these, just kind of give you my general thoughts and opinions on them. If you want to take them, you can. If you don't, no worries. But let me pull these up here. All right, pound Aussie weekly is long. So expectation of the week would be get heavy on the buy side when it's appropriate. 15-minute is short today because the 4 hour is short. So the 4 hour right now, especially because we're getting under our average price there. See that reflected here, got above, boom. So that was a possibility right there on the short side. But when the 4 hour is against the weekly direction, you're going to typically get a lot of whippy behavior. Much more interesting was this one right here. I like this was a good opportunity. Right here, coming down below expansion. This one, because it's kind of far away from this last expansion, probably wouldn't have bought until you got the rotation, because if you just bought this one, there's a potential it could come all the way down to here. So when I see there's that big a risk separation, then I know that there's a possibility, because you kind of have this proof of volatility between this expansion. But right here, on this one, I probably wouldn't have bought just bought this dip, especially if you're trading heavy. You got 1 to 3 positions you're looking to layer into a situation like this. Probably would have waited for the rotation. But what I like about this trade is that if you see right here, you pull back and then you rotate long. Let's look at the time on this candle. This candle was 4 o'clock candle. Let me see here. Make sure I'm looking at this right. Okay, here we go. So 4, okay, yeah, so 4 was a rotation right here. And then this entry happened on 1345. Okay, so it was in the second candle right here. If you look at this, trading up this range, you may say, well, the 4 hours against average price, right? at this point because this hadn't happened. But if you look at this on a higher time scale, this is just an entry going off the basic strategy, the counter trend liquidity, into the weekly. You see that? The weekly is long. So if you're just looking at the 4-hour, then you would have felt like there's no trade here because we're below expansion. But the facts are is that the weekly is still long predominantly. We're expecting all the big moves to happen on the long side as long as that stays green. So when you get a situation, this is nothing more than an entry. If you were just trading the 4-hour and the weekly, forget the 15, would you have not bought here? Right? Coming right back up like a magnet to those expansion lines because your weekly is long. So because you know that, that creates an opportunity on your lower time frame to be able to trade against expansion if you want. Now this is a little more advanced of a maneuver, but do you guys see do you guys see that? That's you have the weekly defined direction. This is, if you weren't trading a 15, this would have been your typical entry into trend. You would have got up to expansion, got above expansion. If it didn't hold above, which it didn't, you would have just covered right here. And now we're coming back. So you would have booked a trade from, let's just say you bought on the rotation when you saw green, from here to here. 877 points. And that's just your minimum. Remember, and for you guys that are new on the webinar right now, all we're trying to do is get you a safe place to get in the money. If you're trading on the basic strategy, when you define the overall direction, we're trying to get you from the rotation to here. That's it. Okay, so you can get into the money, even on a higher time frame, see a significant profit. It's considered a good trade when you have a reference point, an expansion, and you get back to that expansion. If it doesn't get above and hold and go into trend, that's a clue. The fact that it's rotating, not to say it won't keep going, but the facts that it held, it gave you a chance. When you see that it's not going and we're not continuing the trend, you start to see a rotation, you get out. You go from here to here. You tested the trade. You possibly even made a decent profit on it, and that's it. Now you let this plan out. You wait. You wait to see how far this pulls back. This may be a full-blown reversal. So, but that's all you're trying to do. But anyway, going back to what I'm saying, this is just an entry on the 4-hour, and if you know that where the 4-hour is headed, this becomes an opportunity to trade against expansion on the 4-hour because you have an expectation. You have, again, the stable framework to make that call. So anyway, I know I'm getting a little deeper on the subject, but again, you guys will start to see that. If it's an entry on the 4-hour and it looks good, what does that mean? All the lower time frames are going to conform to that. And if you can spot a situation like that, well, there you go. So, okay, let me go take a look at gold. One comment I want to make for you guys too, real quick. We had with the new people that have joined, a lot of the things that people get. This is kind of a basic thing, but a lot of the things that people say is they're like, I watch 28 pairs, and am I going to have to put license keys in every pair and all that? Number one, I don't know why anyone would watch 28 pairs. Until you can do well in one pair, I don't know what the advantage is of having that much confusion. We're always going to push you to specialize in like 1 or 2 pairs, maybe 3. Become excellent. You're watching basically market maker tactics unfold on that pair. It will be an advantage to you to get familiar with the movement of that pair. One pair will do everything that you need for you. So watching 28 pairs, I don't know how you can effectively be an excellent trader at 28 different instruments. I mean, unless, we do have the ATS assistant. If you're looking for only grade A trade opportunities, there could be a approach to that, but even on 28 pairs, you're not gonna be effective at that, even using the signals. So don't trade that many pairs. Just my opinion. You could do what you want. You guys are grown people, but have like 2-3 pairs that you look at tops. And I would try to be an excellent, just master one. And also when you're flipping, you guys don't need to put new license keys in it. If you just go over and you just drag and drop and change your screen like this, you don't have to worry about changing out a million license keys. Just have maybe a couple storm watching pairs down here, and then just change your pairs right here if you want to go look at something different. You don't need to make it that hard. So just wanted to bring that up because we got some pushback and people are like, this is going to be a total pain. And it's like, not if you think about it logically. It's not. shouldn't have to be changing licenses on 28 different screens. Not a good approach to begin with. So, okay, taking a look at gold. So what's our week? Our week's short. We had a little pause, which was this little pullback here on the 4 hour. Came down, held below. Week is red. What does that say about this rotation under expansion? That's in alignment with the week. Okay. Now we're above expansion. If the weekly holds, what is this now on a 4 hour time scale? Is that an entry to possibly go short? Yeah, because if that week holds red, we're going to come down to at least this level. And if the trend furthers on the weekly, we're going to get below this level and trend down through this expansion line and who knows how far. So I don't know if it's not, you got to be careful. If you're trading a 4 hour entry, I mean, if you see a clear rotation, then you can start trading the 15-minute back. But in a situation like this, we just have the candle up. I'm not saying you can't trade it, but if the way that this is right now, I would go very small on your I would go very small on your position size because it could come back up to here. So you got to understand that that's the framework. That's the range the market has given. This is what it's proven. That's your proof of volatility from this expansion line to this. It's not what we impose. It's what it is. So if you're going to enter a trade short on the weekly, be prepared to come back up to here and adjust your position size according to that risk. Now, if you're right, as you get more confirmation, let's say you get another move up and then you get a rotation, put in another position. And then as it comes back, build your short position again as you come back towards this line and see if you don't get a breakout. But if you're just, your first position, testing the water, make it small in a situation like this. So right now on the 4 hour, we're long, we're above expansion, but why I wouldn't be so, we just got a box on the 15. Let's just say we're coming out of session right now. Let's just say we broke out short on the 15 right now. Short, would I buy it? Not necessarily, because the weekly short, I'd be much more keen on seeing it if I'm looking to trade pure momentum on the 15, getting below expansion, then seeing a breakout to the long side on the 15, catching that grade A situation, that first opportunity, seeing what happens there, and then boom, seeing if we can't get a continuation in trend. I like those probabilities better. But like I said, you can see the probabilities through the time frames. And going back to the question we had earlier, how do you know where it's going to settle, where it's going to break with a better degree of confidence? Is by identifying the trend. The fact that the market's trend is the only reason people can consistently have a consistent approach to the market at the end of the day. The facts that they move in one direction. So use that information to your advantage on those higher time frames.
Real quick, I wanted to bring up, because this is the pair that I said to take a look at earlier. So that rotation off of the average price line expansion line, that was way up above what we just saw happen on the 4 hour. Meaning that, if you're trading the little bit longer time frames and you took that trade based off the rotation off the expansion line, I mean, it is just absolutely not plummeted, but it's moved quite a bit from there. And then leading into that on a little bit smaller time frames, you see that rotation off of the expansion line on the 4 hour. If you can literally just use that as a way to, because it's in line with some of the larger time frames, you can literally just base your entry off of that and use that as your risk. I mean, that's a very prevalent point on the charts right now. And then if it goes up through it, not only do you have a clear idea of where your stop is going to be, but you also get a little bit more information that the orders inside of that box are the market maker wants to move up through it at that point. They're not as important. So those lines are always super helpful to base your trades off of. And the further you get away, it doesn't change. The closer you are to those average price lines, the lower risk you have, because there's only one best entry that you can get. And until we get more information, another box, more expansion lines, as it moves away, that still has to be your risk point, unfortunately. But, it's great if you're able to get in and you want to test an entry once you see that initial rotation, because you just have such a clear idea of where your risk needs to be. So anyways, just wanted to throw that out there.
Yeah, absolutely. So, you get a situation like this, you got the weekly headed short below average price. showing that the weekly the demand is going to be headed down. There are a lot of people wanting to sell the market on this time frame, and you get a situation where you're rotating off that average price. Is this not an opportunity to start going heavy? Is all we're saying. And that's the kind of alignment you want to look for in your basic strategy. Now, if you got a situation where you got the weekly above, or I mean the weekly is red, and then you're climbing above, yeah, there may be some trades in here, but how much harder is this going to be able to be to trade if you're against that weekly direction? So you guys are like, I got the system and I'm just buying below the lines and I see my 4 hours above and it's just difficult and I'm having a hard time. Well, that's because you're not in line with that fundamental direction. And not to say that there's not some trades in here. There's probably a trade in this candle right here. There's probably a couple trades in here and maybe one in here. But overall, these are not going to pick up any steam and turn into a really long lasting trend unless it's a major reversal. But more so, it's better to marry yourself to the directional bias of the weekly, and then you'll have an expectation when you get that situation like here, you fall back in alignment. It confirms that alignment by holding below the balance point of the market makers on this time frame. Boom. That's where you'd want to get aggressive in that situation. So those are the kinds of things you want to wait for. You want to wait for that clarity. Don't arbitrarily just look at the candle color and it's above and that's the system and I just need to do this. I just need to buy or I just need to sell. Look at the framework. See what the possibilities are and use those higher time frames to clear things up. That's what they're there for. They're there to give you clarity and to get you looking at, like, instead of just being, oh, I want to buy, I want to sell, I want to buy. That's what everyone else is doing with charts. They see a spike down like this. They're not looking at a box. They just see that their moving average is heading down and they're going to jump this short. They say, oh, that's it. We're going back in trend on the short side. Boom. No, they get whipped out. We see that it held average price. We have a different framework to judge that on. So, that even if you did jump this short right here, you would see that it held above that. And on this rotation, you'd be like, forget it. I'm done. You see what played out here. And so you make that decision quickly.
Real
So
quick, there's a lot of really good examples of that rotation off of average price in the overall trend direction on the 1 hour chart. It's pretty nice right now just for gold.
all right, let's take a look at it. Whew, look at that. That is that same move on the 4 hour. There it is represented on the 1 hour. Came up, held below average price, boom, collapsed in that weekly direction. And see, it came below, held below. See the price down here, held below, because you were trying to get, if you were selling into the weekly direction, right here was kind of your overall risk point. If it gets much above that, if you see that rotation off of that previous average price right there, sell right here. You're just trying to get from here to here. We don't know if it's going to go any farther. We're just trying to come back to that average price like a magnet. The fact that we got below, it settled out and held below, guess what? Everything down here is gravy. You've now earned the right to stick the trade. And that's, however long you want to stay in, that's what liquidity lines are for. If you can ride it from this liquidity line down to this liquidity line, just try to do the best you can. I don't have a perfect answer for how to manage profits. That's why we just try to get to different liquidity levels, and you got to see where you think it's going to go on the higher time frame. But that's the simplicity of the basics of what you're trying to do with the basic strategy. Identify that long-term trend, feel good about it, and stick your trade placement. Don't go super heavy on your entry on your position. Give yourself some flexibility, especially if you're trading a higher time frame, because you may have bought it right here. It came down and held. You may have got back in right here. So if you're down, you may be down a few pips, but if the weekly's still intact and you see a rotation now off this level, go back in. Now you just got more upside coming back to your original target. But if you're trading too heavy, the minute it goes immediately against you, it's going back to the whole pain and pleasure concept in the video we have in the course and on YouTube. The heavier you trade, the more sensitive any price action that is negative to your position is going to put pain on you, which is going to make it's like touching a hot stove. You're going to want to close a trade. The way you get around that is you trade lower position sizes. I know it's not as fun to talk about, but that's how you survive. And then your first inclination of where you're going to enter the trade is probably most of the time going to be wrong. You're probably not going to get it perfectly. So have the flexibility to be able to build a little bit of a position as you get more information. Or let's say you call the first trade and it's totally wrong. It spikes against you. Well, then you're in at a minimum level, and you've paid a little price to learn information. It's probably a totally fundamental direction change on your higher time frame. You paid a little bit of money to learn that. No big deal. Wait for it to set up in the other direction. Hit it again. So anyway, good stuff here, guys. We're going to wrap it up here. We're getting a little long-winded on this. Appreciate your guys' questions. One thing that I did want to go over with you guys real quick. I can pull it up here. Hang on real quick. We have, and we're going to send out an email, probably, hopefully we'll do it today if we get around to it. Here it is. Okay, we have a new forum that is up and running. If you guys go, when you're logged into the website, you have to make sure you're logged in. And same way you can access the courses and software downloads and all that. When you're logged in, this forum button will appear. And there's not a whole lot in here, but we're trying to get discussions going and things. We're going to be putting topics in here and getting things going on. We got a few people that have found it already, but right here, especially this one, I started this thread, long-term trade setups. If you guys as a community, you see something like what we're talking about, clear as day on that weekly chart, 4-hour chart, those long-term setups, post those here, or something that you even want to just get a discussion about. And we're going to do the same thing. If we see something happening, we're going to put it up here for discussion. And through as a community, especially like people running ATS Assistant and getting these higher time frame setups, we're going to put those out here and find opportunities for the community as a whole to take advantage of. That's the end goal with a thread like this. We're also going to have other threads that are going to be just general methodology and any things like that. But this is a way, you guys have been asking for a Telegram group and things like that. We may have some of that later on, but right now this is our starting point. This is a thing where you guys can get in here and communicate with each other and comment on each other's posts and your trade analysis and anyway, I'm hoping that it'll be a great tool for you guys to take advantage of. Like I said, we're going to be posting things in there and joining the conversation and things that we see that could be good setups and that we're looking at in our office. We're going to share with you on here. So anyway, I'm excited to do that. We do have rules in here, which I want you guys to go through and read the forum rules. Obviously, things like profanity and things that are going to be if you're talking bad about someone or anything like that, anything that's not nice, we're not going to tolerate. So you will get in trouble. So make sure you keep the conversation centered on ATS methodology and helping people. Especially, I know I got a lot of guys have been with me for many years. I'm excited for you guys to get in here and give some commentary with your experience too, besides me and Shane putting some stuff in there. But I'm really hoping that this is a good thing for our community to build and share with each other, and that you guys get a lot of value out of that. But like I said, just please follow the rules. We don't want to have to kick anybody out of the program. But if you are stirring up problems or anything, or someone does that, you will be gone. We only want people in this program that are serious, that are getting value from it. We're in this to make long-term subscribers. The only way to make sense to share this with people. That's what we want to accomplish through this forum. We want people to be upbuilt, want them to be learning, want them to see possible trade setups and things that they can go take a look at. That's what the purpose of this is. So anyway, you guys are free to go on here and post things and get the conversation started. And we're excited to see the positive things that come from that. So, and like I said, don't be surprised if you don't get an email announcement pretty soon here, letting everyone know, because it literally, we've just finished the testing on it, making sure it's making sure it's working okay and all that. So anyway, that about does it, guys. Want to thank you guys for being on the webinar. Excited to have the new people that come on since we opened up the waiting list. can't wait to hear about your successes. If you guys need help, support@tradeats.com for trading questions and things like that. If you have technical support questions, use the technical support form in the course regarding software setup or installations, things like that. Please use that because that's the quickest way to get those things handled. It's a direct portal to getting those types of things taken care of. If you have questions about markets and things like that, send them to support@tradeats.com. Some of those will get filtered to me. I'll answer them directly in most cases, but we want to make sure that you guys are getting value and that you are have the best chance at doing this long term. That's our goal with everybody on here, and we want to give you our best. So we will always strive to do that. So again, I thank you guys very much. You're all very much appreciated, and look forward to working with all of you. And we'll see you guys too on the webinar next week. So everyone have a great day, afternoon, evening, wherever you are, and we'll catch you on the next one.